What's up, guys? Welcome back to the trading world. Today, we're going to be taking a look at price action for December 29th, 2025. And I'm going to be specifically showing you three amazing trades using the first presented fair value gap. So stick around. If you want to learn how to trade using the first presented fair value gap, it is one of the most precise ways to trade in the market. Here you can see the first trade. Here you can see the second trade. Here you can see the third trade. All interactions with the first presented fair value gap within a matter of 2 hours. These are all 4R trades that you could have taken. One of them I actually caught live. So incredible stuff, guys. A lot of value today in this market recap. We're going to go ahead and jump right into it. So I highly recommend you guys watch all my videos on the first presented fair value gap because it's going to be important to know what the first presented fair value gap is. But if you have no idea what it is the first fair value gap. So a series of 3 candles where the wick of the first candle and the wick of the third candle don't overlap. Right, like this. And it's going to be the first one. So, for instance, candle 1, candle 2, candle 3, right? It's going to be the first gap that forms after 9:30. Not including in the sequence of 3 candles the 929 candle. So if this candle was a 929 candle, this would be invalid. It needs to be 930, 931, 932 or later. So you want to have this marked out all day long on your chart, and if I just drag this out even until only about an hour later, you can see we already have 3 interactions with the first presented fair value gap. We have one here, a rejection here, and then move higher here. And all 3 of these moves, first to go run this low resistance liquidity above, right? We have these low resistance highs. You can clearly see those are all low resistance. We have a market open wick. This is going to be like a data low. It's going to act the same. So this is the low that formed during market open, and then we have these low resistance highs. All 3 trades that you could have taken using the first presented fair value gap. So I'm going to go through all of them right now. So once again, we have the first presented fair value gap right here. I would have taken this trade, this first trade, had I had essentially seen it as it was happening. Unfortunately, I was looking at something else, but I noticed it like a minute too late, but it was awesome. So here's the first presented fair value gap. You'll note as well, like, by the way, so you can, the way that the way I trade it, it's called the first strike model. It's something that I found through my back testing. Basically, you want to take the first presented fair value gap. So if it's going to be a 1-minute gap, so you want to drop down to an either 15-second chart or a 5-second chart, and you're going to look for a change in state of delivery off of that, and you can enter on either the close or the retest. I have a video on this exact topic called How to Trade the First Presented Fair Value Gap. I highly recommend you guys watch it. I think it's super easy to understand, but if you don't want to do that, you can stick around in this video and I'm going to show you exactly how to do it. So we have the first presented fair value gap. You'll know as well, this is a 2022 model, right? We have a liquidity sweep of these lows. So liquidity sweep. So what is needed for a 2022 model? A liquidity sweep, displacement, and then a fair value gap, right? So here's our fair value gap. And then, so what do we need for first strike? We just need the first presented fair value gap, a sweep into the fair value gap, and then change in state of delivery higher. And you can see that happens here. So that's how we get the first trade, is that 5-second change in state retest to the upside. And check this out, guys. I want to show you this real quick. Check out how nicely the market holds this change state delivery. So here's the trade, right? So here's the first limit for value gap. We get a sweep into the first limit for value gap, and then the market backtest this change in state of delivery. Look at how nicely it backtests this 5-second change in state of delivery. What does that show you? It shows you that smart money is getting their orders filled at the change in state of delivery off of the first presented for value gap. And yeah, crazy, because we go up 4 projections from the high of the series of down close candles. This is the change in state of delivery, right? Which is the high of the series of down close candles. A change state of delivery. Every change state of delivery is also going to be an order block. So this is also an order block. And so when we retest this, orders are getting filled. And then you go up 4 projections, and we even go up 7 projections and further. And how could you have known to target higher up? Well, we had all these low resistance highs above. So that was the first trade. Then, once again, what happens next? Same thing, right? We have the first presented for value gap again, but this time the new draw on liquidity is actually the low created from market open. Once again, like I said earlier, this is going to be like a data low. It's going to, basically, you're going to want to treat it as if it's a data high or a data low. So it's like, once again, it's data high or data low is just the spike created from a news event. And market open is going to create that same kind of thing, where the market is going to create some kind of spike, and it's going to leave this like very, very nice liquidity pool of stop losses. There's going to be a ton of stop losses at the edge of the wick of market open, right? So here's market open, boom, there's where the market goes to, and it creates this wick. There's going to be a ton of stop losses at this wick. You can visually see that that is the case by zooming in here and then seeing how the market reacts so perfectly off of this low, right? That is clear that that is manipulation, right? That is the market manipulating the people from market open, stopping them out, and then reversing. This is going to repeat in the market over and over again, right? So there's your 930 market open wick, which is going to be like your drawn, which is going to be like your data, essentially like a data low. So 930 market open wick, and then what's this, right? We sweep out the high, so there's your sweep, bang, and then we have another, in this case, 5-second change in state. Once again, you can do either 5-second or 15-second. It just depends on the context. In this case, 5-second makes more sense. And once again, it's all going to be based off of the drawn liquidity. So in this case, the drawn liquidity was lower because we had the market open wick below. And that was a very important target that the market still wanted to go to. So you can see, here's a visualization of that trade, right? We backtest that 5-second change in state, and then measuring out this right here, which this is an order block, right? This is an order block because every change in state of delivery is also an order block. So boom, boom, these two up close candles together, this is an order block. So there's a change in state off of that first presented fair value gap, and then we send this down 4 projections, bang, stop loss goes above the order block, or you could have it even tighter like it is shown right here. So beautiful. And you could have also just left it to go target the market open wick, because as always, the true highs and lows and targets within the market, the draws on liquidity, that's what draw on liquidity is. It's a high or low in the market. It's going to override whatever projections you make. Like if I project this out, I might project out 1, 2, 3, 4, 5, 6, whatever projections. But what matters is the market open wick right here, right? This is the actual draw on liquidity. So you can see that we retest that change in state of delivery, and then we go straight to the draw on liquidity. So this is your entry, the retest of the aligned time frame change in state of delivery off of the first presented for value gap, and then take profit at the market open wick. Okay, then what happens next? Once again, now we have a third opportunity to trade using the first presented for value gap. This one I took live. I took this one live. You can't fake that, right? You can't fake that I took this trade live. You can clearly see right here that I took this.
This is for you.
Thank you. I took this live. Let me show you right here. Here's my execution. You can see there's no other executions on this chart. Now I entered right as soon as we retested the change in state of delivery, so you can see literally right as we get it, enter right on the retest, but you could have also entered over here. And anyway, here's the trade, right? We have the first sort of value gap. Here's the change in state of delivery. Once again, change in state of delivery, guys. It can be either a series of down close candles, or it can be the lowest down close candle. It can be either. It doesn't have to be, like, that was something that confused me for a long time. Change in state of delivery can be a series of down close candles, but it can also be the lowest down close candle, because a change in state of delivery is just an order block. It's the same thing. So, right, here's that 5-second change in state. Off of the first presented for value gap, we get a liquidity sweep, change in state of delivery on the 5-second. Once again, you're looking for either a 5-second change in state or a 15-second change in state. Bang. And then we go up to go run all of these highs. So as always, I like to target usually 4 projections, and then if you're feeling aggressive, you can target 7 projections. And so you can see how both of those were amazing targets, right? Here's 4 projections, and then here's 7 projections. Both of these amazing targets for this trade. Now, when I took it live, I did just take all off at 4 projections, which is totally valid. But just to show you guys how nice this really is, right? So I love the first strike model. I think it is one of the most precise and most accurate models in the market, and I've been backtesting the market for 2.5 years now. So I don't think, from what I've seen, this is the trade that will repeat itself over and over and over again. Like more than anything else. I see this happening all the time. And yeah, guys, crazy stuff. Like I said, up 4 projections and then up 7 projections. There you go. As far as other things that happened, right? This was the market open wick. So why did the market come all the way back up from these highs, all the way back down to this market open wick? Well, because it's a market open wick, right? It's a data, essentially going to act like a data low. This is going to act like a data low. It's going to be a super strong draw on liquidity. Gravity's going to pull down on the market. And smart money, as the market's going through here, smart money's not going to long until they see the market open wick taken. Once they see that market open wick taken, smart money is given the green light to start longing. And you can see now all these highs that once were high resistance, right? All these highs that were once high resistance now become low resistance. And it's only after the market open 9:30, I'm going to call it a data wick, even though it's not, because it's going to act like one. But the market open 9:30 wick gets taken. Now we are good to go run all of these highs. And you know what's interesting is if you really wanted to be aggressive, you could look for this market open wick to get taken. You could have literally taken that IPG and then taken this all the way up to go run these low resistance highs and these highs. And it goes to show the power of really understanding time and price and understanding like why every single move higher failed until this point. It was because the market was seeking to go take a very specific draw on liquidity. It was the market open low. So pretty cool. We'll look at some more trades. To get on side to target that market open low, you could have taken this inversion, this dodgy one setup for life that I liked. This is another good setup that's going to repeat itself over and over again. Check out Dodge's YouTube channel because he will talk about this all the time. But essentially, we'll get an inversion for value gap to target a data high or a data low. In this case, I'm using the 930 open wick, but it's the same thing. Here we just have a liquidity sweep SMT with the S&P 500, which is called ES. And then we inverse this gap and then go down to the market open 930 wick. So that's pretty cool. And yeah, what else? On the low time frame, right at market open, this was a 2022 model. So you can see here. Now, on the 1 minute, it's not so obvious, right? Because all you have is the sweep and then the gap, right? The liquidity sweep, the S&P with ES, and then the fair value gap. So this one you might say, oh, there's no break of structure. That's not the relevant part. The part is there a displacement, and you can see that there is. But when you go on the 15-second, you can clearly see that it is in fact a 2022 model, and it's a very nice one. We had a liquidity sweep of these triple equal lows on the 15-second. We have a rejection block that forms at the bottom of the S&T. So this is the Phoenix entry. You can see how we perfectly tap the midpoint of that 15-second rejection block. We get displacement higher. So what do you need for the 2022 model? You need a liquidity sweep, displacement, and then a fair value gap to form. You can see the fair value gap forms here. If you pyramided off of the rejection block, which is called the Phoenix model, so if you entered on the Phoenix model and then entered on the 2022 model, you get 15R off of that, 5R off the 2022 model, and then you get a 20R trade to go run the LRLR. Once again, very advanced stuff, but just goes to show what is possible in these markets, and I think it's worth talking about. And also the true opens, you can see that we perfectly manipulated our 90-minute true open, which is 922, and then we also perfectly manipulated 928, which is the 22-minute true open. So pretty cool. Let's see, what else do I want to talk about? I talked about the dodgy one setup for life. And then this was a nice pin bar. This is the last thing I'll talk about. Essentially, we had first I'll talk about how this was a 2022 model. Right, so same thing, right? Liquidity sweep of highs off to the left, break of structure or displacement, either one. But here is the technical break of structure, this orange line. This one's also a break of structure. This is valid. This is valid. But once again, it's about displacement, not necessarily break of structure, right? It's about displacement, a liquidity sweep, displacement, a fair value gap getting created, and you can see here's that fair value gap. And then bang, you can enter as a soup of this high into this fair value gap. So once again, all you need for 2022, liquidity sweep, break of structure, or displacement, either one, and then a fair value gap to form. Entry on the taking out this high. We actually got an SMT with YM here. Note this upper imbalance holding this high of this wick here, which is pretty cool. And then we deliver lower, and let's say you just wanted to get extremely precise, you could have used a pin bar off of this. So check this out. You could have taken a pin bar off of this. By the way, this was also perfectly at OTE of this displacement leg. This was at I think 10:30 or 10:45. I can't remember exactly. And then displacement, OTE tapped with SMT, bearish SMT with YM, And then here's the pin bar, right? So if you guys don't remember how to trade pin bars, I just covered it in my pin bar video, but basically, pin bar, they look kind of like a, like a little spiky Darth Maul lightsaber where you got wicks on either side, but actually you don't even need wicks on either side. It just needs to be like an indecision candle. A doji is essentially what a pin bar is. And yeah, basically you want to see the market retest that. And under the right context, pin bars are going to be amazing sniper entry points. Like in this case, this was a really nice pin bar to re-enter on. Boom. And then we go 7 projections and then further off of that pin bar. So very, very cool. Just wanted to show how you could have caught something else. And you'll also know what's at the high here. I just now noticed this. What's at the very high? An outside bar. I have a video coming out on outside bars, short form video, in 3 days, 2 days, I don't know, coming out soon. And yeah, you can see the old candle, the high and the low of that old candle get taken, and that is basically a confirmation that the market is reversing, right? So you enter on the close of that candle that takes the high and the low of the previous candle, and then you take that down 2 projections, or you can take it down even further. In this case, it literally caught the exact high. So that is pretty cool. With that, guys, I think I'm going to end today's video. Hopefully you guys enjoyed. You found this valuable. I'm going to try and do these every single day. I do think it is very important. And with that, I will see you guys in the next one. Peace out.